11 o'clock, so let's get this show on the road. So good morning, everybody, and welcome to this week's show. Our James Carthew is on holiday this week and next, having a well-earned break, as is our Richard Williams, who usually does the sort of property news for the show. So I'm here to take you through both today and next week. Jane is going to be holding the microphone and taking you through the news. As usual, I will begin by taking through this week's news for investment companies and REITs. Then I'm going to bring on Nick Brind, co-manager of Polar Capital Global Financials, to talk about that trust. I think it's a super time to be looking at that, given rising inflation and interest rates. I think we have a really interesting discussion with Nick. Just a little bit of housekeeping, as always. If you have any questions, please pop them in the Q&A box or email them to me at mr@martinandco.com, and we will try and answer as many of these for you as we can. Beginning with the news, it's been a very quiet week in the space. Most of the news that has come out has related to property acquisitions, but it's been largely run-of-the-mill stuff, really not too much to get excited about. That said, there's been a transaction by Urban Logistics REIT, or Shed as it's more commonly known, that looks quite interesting given what's been going on in that space. And I'm going to talk about that in a bit more detail, and then I'd like to talk about a couple of migrations up the main market, both of which I think are good news and might easily get passed by. So let's begin with Shed. So the whole logistics market has been under a bit of a cloud following sort of comments by Amazon that it overextended its expansion. It's going to be slowing the pace of that quite dramatically. And it's put the sort of market, or at least, you know, for the REITs, in a bit of a spin. The other thing is, obviously, with rising interest rates, there's concern that this would impact yields, which are obviously a big driver of returns of these vehicles, given that it's pushing up the sort of cost of capital. The result of that has been that ratings of logistics-focused REITs have swung sort of wildly from very significant premiums to NAV to quite large discounts. But we've been saying for a while that if you look at the sort of dynamics underlying the demand for the supply and demand for the logistics space, this would suggest otherwise. It doesn't really make sense to us that you're going to get the sort of kind of falls in asset value that the sort of market moves have been suggesting. And this appears to be sort of borne out by this week's transaction by Shed. So that's really why I want to have a look at that in a bit more detail. So what's Shed done? Shed has announced the acquisition of 5 basically urban logistic assets for £90 million. And it says that all of these have significant potential for further value creation through active asset management, which is something that, you know, all of these REITs have been good at. I think, you know, Shed has been particularly good at. Now, 4 of these properties are income producing already, and 1 property is vacant, and that property is already being marketed. Interestingly, with one of the other 4, although it's not yet vacant, actually that really renewed or lease expires in about 2 months' time, and that is actually sort of quite a or the existing lease is quite a substantial discount to the sort of going market rent in that particular place. So they're obviously going to relet that, and, you know, hopefully generate a decent uplift. So one of the things that's been quite interesting that sort of Richard Moffat, the CEO of Shed, has said is that, you know, there has been a lot of volatility in this space, and they've just had to sort of kind of look through that, wait a bit, be patient. And he thinks that actually they've managed to get all of these on pretty advantageous terms. Now, if you sort of look at our website, I've done a piece on this and breaks down each of the assets in more detail, and that was sort of done yesterday if anybody wants to have a look. But the sort of key thing that I took away from it is the net initial yields for all of these range from about 4.2% to 6.5%, or 4.5% on a blended basis. And these look similar to what we were seeing in terms of sort of transactions prior to the announcement from Amazon that put the whole market in a spin. Just the fact that these are comparable says that actually asset values are holding up firm, and actually that has implications given that we've obviously seen all of the share prices of these things derate. So I think the big question is why. And as I said earlier, we've been saying that the occupational supply demand balance looks strong, and that continues to be the case. Got some sort of stats here that Richard sort of gave me prior to his departure. Around sort of 15 million square foot of new leases were signed in the second quarter of 2022. So, you know, despite all the hullabaloo, actually, occupiers are still taking up space, and that sort of took the first half year record take up or sorry, new record of 28.6 million, which is markedly ahead of the sort of same period last year. The interesting thing, and this is sort of one of the things we have been hammering home, is that whereas online retail accounted for about 35% last year, it only accounted for 80% of the total this year, which is arguably not surprising. But clearly there's plenty of other demand there that has just taken up the slack. And I think the sort of key takeaway that I would put to people is that logistics is just not reliant on this continued boom in e-commerce. But let's have a look at this a little bit more. What are the sort of key drivers behind this? Well, to data, I think for Savills and CBRE, data suggests there's been a resurgence in demand from manufacturing automotive sectors. And this is not really so much of a supply when you consider what's been sort of happening in China and other parts of the world with COVID and lockdowns and restrictions, etc. There's been much more of a move away, from having sort of just-in-time delivery to actually looking more at sort of just-in-case supply. And there's been big emphasis on sort of reshoring and basically shortening supply chains. And I think there's much more emphasis on supply chain resilience and an understanding that really you need to hold more inventory. And if you look at this, there's actually still a chronic lack of space. But let's once again explore this a little bit more. So once again, just pulled some stats from CBRE and Savills. So CBRE reckons that there's about 19.4 million square foot of space currently under offer. And actually, a lot of this we think will be to pre-let to new builds, etc. So quite possibly that takes actually up a good amount of supply coming onto the market. Savills reckons that actually in terms of long-term requirements, it has always been tracking about 200 million square foot of demand. On the supply side, Savills reckons there's about 18.4 million square feet currently available, and CBRE recommends or estimates that the amount of space that is ready to occupy is actually historically low, about 1.2%. And all of this combined suggests that we've still got this huge sort of demand supply imbalance. And if you sort of think about the scale of those numbers, we think it sort of potentially screams rental growth, but we will see. There's one thing that perhaps could upset is if there was a huge amount of new supply came on board. We think the delivery of new buildings is unlikely to keep pace with demand. Savills has tracked about 16.5 million square foot of spec development due this year, or the remainder of this year and next. Considering the term demand is about 200 million square feet, that's still a massive, ongoing shortage of space. Given the market backdrop, we expect probably some new developments to be announced, but we would expect those to tail off. Naturally, investors are going to hold off until they've got a bit more certainty. So we think that at least for the meantime, it's hard to see that sort of structural imbalance being addressed. And this is sort of quite key. So if you sort of look at the end of this chart, you can see that this is for Urban Logistics REIT. I think the same kind of applies for the others, but I've sort of focused on this one because they've sort of done the recent announcement and we've actually got some recent values. And also, I think in part because, in our view, the sort of urban part of it, where clearly space is more constrained, may well hold up better than the big box stuff. I mean, that's yet to be seen. But I think it's sort of worth perhaps just looking at that in detail. But I think there is a interesting read through to the other vehicles. But I mean, the key takeaway is if you look at the end of the chart here, you've seen the sort of share price moved around dramatically. It's moved out to a sort of marked discount, having predominantly, as you can see with these, if you look, the green line is the NAV, the blue line is the price. This thing has predominantly traded at a premium to NAV. Obviously, exceptions where when price etc. collapsed during March last year, in the sort of face on March 2020, in the face of COVID, but quickly rebounded. I think the other thing to remember with some of these where it perhaps shifts under is part of that is the fact that obviously when the NAVs come through, certainly for the purpose of this, they're adjusted retrospectively. You wouldn't have necessarily known when this was trading what the NAV or the NAV was going to jump up in the way that it has, and same here. So key message, these things have predominantly traded at the premium and they're not now, but actually if asset values hold firm, in this suggests perhaps there could be some recovery here. just to emphasize that point, this is the sort of discounts that these are now trading at. As I said, I think the sort of last mile or last touch, as some like to call it, is quite possibly more insulated. So this is probably why these have not suffered as heavily. But I think all of these, probably on a long-term basis, look like they could actually be sort of attractive right now. Just looking at the logistics REITs more generally, the sort of key thing is that they have all got a proven track record of growing through their sort of rents through intensive asset management, and that can be done in a whole host of ways. So, often they're looking for sites that have got sort of low coverage that they can expand, etc. Looking to solar installations and the like, and actually improve the energy ratings of these things and basically make them sort of more valuable. And they've all been good at doing that. As I said, the occupational market is healthy. If you look at the previous slide, the market, bear in mind these things are all chunky premiums, seems to be pricing in falls anywhere between 10% to 30% in asset value. We think if these asset values continue to hold up, these share price falls will likely revert, and this might take some time, but it could actually be quite sharp. I think as a long-term income investment, the logistics REITs may be looking pretty attractive right now. Just to sort of emphasize the kind of returns that have been provided. Obviously there's an element of recovery perhaps with some of these, but these have been pretty strong over the last 5 years in general, particularly during the last 12 months, but the share price moves have just not been reflected in that. If we look at sort of Shed once again in particular, as I say, it's currently trading on a 8.7% discount, historically traded at premium. You're still getting a decent yield off that, and with the asset management initiatives, there's potential to expand that. It is a good size, market cap of 809 million, plenty of liquidity, sensible leverage. Is it potential opportunity? I think yes. Is there a read through to the wider logistics sector? I think yes. Now I just want to move on to the sort of migrations up to the premium segment of the LSE. There are a couple that I wanted to talk about. The sort of first one is Rockwood Strategic, which came out with an announcement yesterday, and the other one is Digital 9 Infrastructure. We'll start with Rockwood Strategic. So this is basically going to be, not said when yet, but it's going to move up from AIM to the main market. For those who are not sort of familiar with this was previously called Rockwood Realisation, and prior to that, Gresham House Strategic, and originally it was Spark Ventures. There has been a high-profile tug of war over this vehicle between sort of Hardwood Capital and Gresham House. Gresham House had, I think a sort of big stake in it, and certainly had a lot of aligned investors when Harwood came after it. Harwood was actually ultimately able to win them over and took on the contract, but shareholders voted to put the thing in runoff, but then there was a bit of clear out of the register, which brought the size of the thing down. I mean, Harwood did say in the short term that they would actually run this for free. But actually, when it was actually put into, or voted to be put into runoff, sort of within a year, they've agreed to sort of reverse that decision. I mean, the thing is pretty small, 35 million market cap, but a lot of effort has been put into sort of winning over this vehicle, and Harwood and the board look very heavily focused on sort of turning it around. What's driven this move? Well, they are very much looking to the future. Board says it wants to improve Rockwood's tax efficiency. So basically, they want to convert it into an investment trust for the next financial year, which commences 1st of April 23. And to achieve this, they need a main market listing. Obviously, as I say, it's still a sort of 35 million market cap trust, so there is a long way to go. But they believe it will broaden the appeal and boost the liquidity, and they are probably right. But I think ultimately the key thing here is they are going to have to prove that they can manage this, and if they can, they should be able to attract more assets and actually grow the thing. But if you consider the size, there is sort of clearly a long way to go. So, in my mind, one to watch. The next one would be Digital 9 Infrastructure, and this is entirely the other end of the scale. So this is a new vehicle. It's sort of coming up for sort of 18 months old. listed last year on the specialist fund segment of the LSE. Its IPO raised, a very healthy, at the time, £300 million. But it's sort of not resting on its laurels. It came back June last year, raised another 175 million. Back in October last year, raised another 275 million. I think the key reason at the time that it launched onto the SFM, rather than just going for a straight main market listing, was in terms of what the managers were looking to acquire, sort of vis-a-vis what they had in the pipeline. So, within 6 months of listing, they spent 231 million on, for example, Vernholders, which is a huge data center in Ireland, which they paid cash for. That was a very, very heavy part of the portfolio, and basically that level of concentration wasn't going to work with a main market listing. It needed to be some more diversified than that. Anyway, as we said, it's done a lot of equity raises, and this has effectively diluted this holding. So this has allowed it to migrate to the main market. Board expects, and we agree, that this should help increase its profile. It should help diversify the share register, and I think they also may benefit from potential FTSE index inclusion, which at the moment is not open to it. Expect that they will probably want to come back and raise more cash in the future, which is sort of part of this. Once again, we actually think this is a good thing. I think it's, in a way, it's a shame that retail investors, because it's been on the SFM, it's not to say that retail investors can't buy things on the SFM, but it is just hard. A lot of platforms don't carry them. You've got to jump through more hoops to do it. As I say, it's not impossible, but it is a challenge. I think the sort of key thing that we would like to see is, if they're doing more fundraising going forward, if they are sort of more inclusive, rather than getting these things tied up very quickly in a day or so to big institutional investors, obviously can write the big checks. If they, or certainly we'd like to see them undertake things like intermediaries offers, etc. It would actually help other people get in. But I think once, very pleased to see this happen. I think another one to watch, and hopefully small investors are going to get some more access as a result. So all in all, a good thing.